Hello everyone, and welcome to another monthly live equity trust training program. In today's training program, we're going to be talking about buying real estate in all real estate markets across the country. My name is John Bowens from Equity Trust Company. Excited to be here on today's program. Excited to have our viewers on for another live Facebook training program. Again, in this training program, we're talking about buying properties all across the country. And the inspiration for this training was when I was out speaking at a seminar, a real estate investor seminar, and one of the attendees raised their hand and said, John, I'm struggling with this whole concept of using a self-directed IRA because what I find is the average investor that I'm working with has between $60,000 to $70,000 in an IRA, and the median home price for us in this particular market is between $175,000 to $200,000 in value. Again, that was in that particular market, and so that inspired me to have this live training program to talk about different methods of financing real estate using a self-directed IRA, because it's not just using your IRA as a cash buyer to acquire property. So that leads me to the three methods to financing real estate with a self-directed IRA, 401k, or other tax-qualified account. The first method is buying 100% outright. So your IRA is going to be a cash buyer. You have ample funding in the IRA to finance the entire purchase and rehab of the property. The second method is co-investing, where your IRA is partnering up, if you will, with a spouse's IRA, another investor's retirement plan, or even your non-IRA capital. And we'll give you an example in just a moment to display and demonstrate how this functions. And then last but not least, it is possible for your IRA to borrow money to acquire a property, whether that's through a seller carryback mortgage or you're actually going out and finding a non-recourse lender. So from the very beginning, let me give you an example of buying a property 100% outright with a self-directed IRA. Now, it's very important for those out there that aren't familiar, brand new to the self-directed IRA concept, to understand that a self-directed IRA is really no different than any other IRA, 401k, thrift savings plan, 403b, or other tax-qualified retirement plan. Self-directed is just an industry term. It indicates to you as the investor that you can take control of your retirement plan. You can invest in what you see is best serving for you and your portfolio. So most investors are familiar with putting their money with a financial advisor or a broker that's going to help direct their funds. With a truly self-directed IRA, you have the ability to take control of the retirement plan and make the decisions on your own behalf. Equity Trust Company, this is what we specialize in, helping investors invest in real estate and other alternative assets using a self-directed IRA. So of course the first step would be for an investor to roll over a 401k, transfer an IRA, move over funds from an existing plan into a self-directed IRA to get started. Okay, so let's take it from the very top here, buying a property as a cash buyer with an IRA. So let me give you an example. Let's say, for instance, you're going to buy a $200,000 property, and we're going to say that this is all-in purchase and rehab $200,000. And let's assume you have $210,000 in an IRA, okay? So you have more than enough funding available in the IRA for the full purchase and rehab of this property. So step one, you would transfer again or roll over your funds into a self-directed IRA. So you create a self-directed IRA with Equity Trust Company or a custodian of your choosing, and then you direct that custodian to acquire this property. So the IRA purchases the property, and let's say that the property purchase is around $180,000. So the IRA takes title to the property. It's not in your name, it's not in an LLC's name, it's actually in the name of the IRA. So now that you have a deed to the property, and that's the asset that's under custody in the IRA, you put in, let's say, $20,000 worth of repairs. So the IRA pays for all of the repairs. It's important to understand in the self-directed IRA business that when you buy a property, particularly 100% outright, your IRA is responsible for paying for 100% of all of the expenses. Okay, you couldn't come in with personal funds to finance the rehab of the property. So the IRA owns it, the IRA pays for all of the fix-up and repairs, and then let's say you sell the property for $250,000. So we sell the property for $250,000. The $250,000 is returned to the IRA, You were in it for $200,000, so that's a net profit of $50,000. Now, this $50,000 in profit is returned to the self-directed IRA. That doesn't go to you as an individual. If it went to you as an individual, it would appear on your 1040 as ordinary income. In this instance, because it's your self-directed IRA and there's unique tax privileges associated with the self-directed IRA, all of the income flows directly back into the self-directed IRA tax exempt. And you would either pay taxes on the seed or on the crop. It depends on the type of retirement plan you have. If it's a tax-deferred account, eventually you pay taxes when you withdraw the funds. If it's a tax-free Roth account, it's going to be tax-free for the rest of your life. And we did an entire training on Roth IRA and traditional IRAs in a previous session. So again, in recap, we bought it all in rehab and purchase for $200, sold it for $250. $250 went back to the self-directed IRA. Again, that's if you have enough cash available in the IRA. So now let's talk about if you don't have enough available cash in the IRA. And when we say IRA, we may also be referring to a child's Coverdell education savings account or even a health savings account. And some investors have SEP, SEP IRAs, or solo 401ks. So there are other tax-qualified accounts offered through Equity Trust Company and other financial institutions, but for the purpose of this presentation, we're using self-directed IRA. But know that you can use any of the account types, if you will, offered for these types of methods of financing real estate. So the next example we're going to use is co-investing, partnering your IRA with another IRA investor or another entity. So we're going to call it, again, a $200,000 purchase. And in this instance, we're going to fund $50,000 of the $200,000, and we'll call it all-in purchase and rehab. So $50,000 from the IRA, and then $150,000. Let's say this is with your non-IRA money. So in this particular instance, we're partnering with our non-IRA money. Now, let me add a quick disclaimer here that in this particular instance, because you are a disqualified person to your IRA under the provisions of the tax code, you have to be careful that you don't disproportionately pay for expenses or allocate profits. So you can't unreasonably benefit from the transaction. So you got to make sure that everything is done proportionately. It's always important because Equity Trust is a passive custodian. We don't render tax, legal, or financial advice. That you contact a CPA or a tax attorney or your financial advisor to review these types of transactions to ensure you're compliant with the Internal Revenue Code. So again, $200,000 all-in purchase and rehab. $50 goes in from the IRA, $150 goes in from your non-IRA money. So what you're doing is you're entering into what they call a tenants in common arrangement. So your IRA will be listed on title as a 25% owner because your IRA put $50,000 down in the $200,000 purchase, and then you personally will have a 75% equity interest in the property. So going forward, all profits and all expenses must flow 25% to your IRA and from your IRA, and 75% to you and from you. All right? So in this particular example, let's say we sell the property just like we did in the last example for $250,000. So we made a $50,000 profit. So this profit here must be split 25% to our IRA and then 75% to us personally. So you're looking at about 12.5, 25% of 50,000, 12.5 going directly back to the IRA, which is tax exempt, of course, like we talked about, those unique tax privileges. And then the remaining profit goes directly back to us personally. Or some investors will put this through an LLC. Now, you may fill in this non-IRA. Maybe this is a spouse's IRA. I have a client in Indianapolis, Indiana. He partnered on a deal, bought a property for $75,000, and 82% of the property was owned by his IRA, and 18% was owned by his wife's IRA. And about 3 years after they bought the property for $75,000, they sold it for $210,000. In the interim, they were renting it out, cash flowing at about $1,500 a month. And they made about $140,000 in their Roth IRAs, 82% going back to the husband's Roth IRA and 18% going back to the wife's Roth IRA. So you can partner with a spouse's IRA, partner with your non-IRA money. You may bring in 3 or 4 IRAs. and all income and all expenses flows in accordance with the ownership interest. Now, there are a lot of ways that you can carve up these types of transactions. And in fact, what we did for you in this session, because there's so many different methods and so many different ways that you could co-invest, we put together a report, and it's called the 10 Methods of Financing Real Estate Purchases. And in this report, it's going to detail all of these different co-investment models that you could explore and you could use as food for thought. Again, this isn't a guide that's going to give you tax advice or financial guidance, but it's going to get you started so you can better understand how this business works and how it can be effective for you and your future. To download the guide, you'll want to go to www.try.trustetc.com/Facebook. You'll also see in the body of the copy just below this video, you can also click on the link. It'll take you directly to the download page. So I'd encourage you to take a look at that. If this is something that is an aha moment for you, you never knew that this existed, this is something that can work for you, what I want you to do is give us a big like if you could. So go ahead and hit the thumbs up and give us a like to let us know that this is a big aha moment for you. So that is co-investing or partnering. Let me move on to debt financing, or your IRA borrowing money to finance properties. Now, when your IRA puts a property under contract for investment purposes, there are different ways that you can finance the transaction. Some investors I've worked with, they'll negotiate to buy the property on terms, which means they'll negotiate with the seller, they'll give them a down payment, and the seller will carry the financing. There are other investors that go to a private lender or maybe a hard money lender, and that lender will loan money to their IRA. So buying properties on terms and then going out and getting private financing. So let me give you an example of how this would work. In this particular scenario, we're buying a $50,000 property. Okay? And let's call this property that's for $50,000 a 3-bedroom, 1-bath, 1.5 bath home, we'll call it. All right? And we're buying it for $50,000, and the seller is willing to carry the financing. And the terms of the contract are as follows: $5,000 down with our IRA. All right? And we're going to call this a Roth IRA. It doesn't have to be a Roth IRA, but for these purposes, we're going to call it a Roth IRA. And the reason why I say Roth IRA, not that one is better than the other, this depends on your particular situation, but you'll learn in future sessions that the Roth IRA is what we call a tax-free retirement account. When you put money in, you put it in after tax. It grows tax-free for the rest of your life, and when you pull the money out after the qualified retirement age of 59 and a half and it's seasoned for 5 years, it's tax-free distributions. So what you can achieve with the Roth IRA is tax-free growth. We're leveraging compounding interest in the absence of taxation, which can have a very profound effect. So back to the example, we set up a Roth IRA, we fund it, we put $5,000 down on the $50,000 purchase. The seller is carrying back a mortgage in the amount of $45,000. All right, so the seller carried back mortgage is $45,000. Our IRA is going to owe $45,000 on this deal. Our intent on this transaction is to buy it, fix it, and resell it for a profit. So now we're going to put, let's say, $10,000 worth of work into the house. So we put $10,000 worth of work into the house. With our seller carryback mortgage, we're in it for $60,000. So the Roth IRA owns the property. The Roth IRA has borrowed money, so the IRA has debt against it, just like you take on a personal mortgage. In this instance, your IRA is taking on a mortgage. Important to understand that when the IRA borrows money, it must be a non-recourse loan, which states in the event of a default, the only recourse is against the subject property. Furthermore, you cannot personally guarantee that debt. That would be considered a 4975 prohibited transaction. Okay, it's disallowed. So we get our non-recourse loan, we put the property under contract, we buy it, we put $10,000 worth of work into it, we're in it for $60,000, and we're going to sell it, let's say, for $90,000. All right? We sell the property for $90,000. That's a $30,000 profit, right? So after we've paid off our mortgage, that's a $30,000 profit. Now, This profit, although is initially returned to the Roth IRA tax-free, there are some tax implications that I have to make sure I make all of our viewers aware of. It's a special tax on IRAs called unrelated debt financed income tax. And it occurs when your IRA borrows money. Because the way that the government is looking at this is you're taking money from an outside source. You're borrowing money. Therefore, you're going to have to pay a special tax on a percentage of the profits. So what percentage of the profits is taxable? Well, in this instance, we put 5 down for the $50,000 purchase. So our average indebtedness, we're going to call it, is 90%. Or in other words, 90% of the property is leveraged. Therefore, 90% of all of our net profits are going to be subject to this special tax, again called unrelated debt financed income tax. Again, it only is incurred when your IRA is borrowing money. So in this particular instance, 90% of $30,000 is approximately $27,000. All right? So we have $3,000 of the $30,000 going back to the Roth tax-free. We have $27,000 that's going to be subject to this unrelated debt financed income tax. So the tax rate that is used for this particular special tax is the trust tax schedule. And under the trust tax schedule, any income over $12,600 is subject to a 39.6% tax rate. So if we take 39.6% of $27,000, that gives us approximately $11,000. And then our net profit, after taking into account the $11,000 in taxes that we're going to pay, is around $19,000. So in this particular hypothetical example, okay, again, this is a hypothetical example, we make $19,000 in profit into our Roth IRA tax-free. So what I would ask you is it beneficial for someone only having $15,000 down in the deal, paying $11,000 in taxes, to make $19,000 in profit? Most would say yes. $15,000 in the deal, I pay $11,000 in taxes, but I get $19,000 tax-free in my Roth IRA. Many would argue that that's a really good deal. Now, you have to determine whether it's a good deal for you or not. Again, you have to understand that there are some tax implications here, but it can be extremely lucrative if you structure things properly. You work with your CPA or accountant to determine what's best serving for you. So again, from the very beginning, we buy it 100% outright from the IRA. We can co-invest, or we can take on debt financing. Remember, we have the 10 methods to finance real estate transactions I would encourage you to take advantage of. Just go to the website URL and download the report. If this was an aha moment for you, again, what I want you to do this time is I want you to select wow. If you had an aha moment, you caught something in this training session that you'd never heard before, you never knew about leveraging in your IRA, you never understood that you could partner with your other tax-qualified funds, again, what I want you to do is hit wow for us. That being said, what I want to do is I want to thank everyone for joining us on another live Facebook training program. I look forward to seeing you on the next call.